Good morning, Rudy Campos here, Remax Gold Coast Realtors, 479-2992. This morning I'm here with Daniel Barrera with Metropolitan Home Mortgage. He's been in the business 11 years. He does loans. And I've also known Daniel for, 20-some years?
Yes, 27 years.
He used to be my former student and player at Oxnard High School. So I wanted to interview Daniel simply because we have a lot of opportunities to meet with first-time buyers, and sometimes people don't even have an idea where to start. So if someone is looking to buy a home and they've never done this before, what would you say are the most important things that they need to do to begin the process?
Well, the first step that I would consider the most important is to verify the credit. See what we have in the credit. Sometimes we have the belief that we don't have good credit or credit's too high. So the first step is to run the credit report, see where we stand with the credit, that way we can determine if we need to improve our credits or we have the right credit to get into the house. Now, saying that, with a credit report, we're going to be able to see what the debt we have. Meaning when we're buying a house, we have to consider all the debt to acquire the house. We have to consider the debt of the house. That means the monthly payment that we're going to have in the house with tax and insurance, and mortgage insurance if that's the case. And also we have to consider every single payment that we have, auto loans, credit cards. So all of that has to be considered when we're pre-qualifying for a house.
Okay. So obviously credit is important. We know that credit makes a difference between what kind of rate you can get, whether you can get a loan or not get a loan. So obviously credit is important. So if you're buying a home, the first thing to do is check the credit. Now there is also a difference between just a partial credit report versus a full credit report, right?
Yes, we can run that credit report for free in myannualcreditreport.com, but the problem is it's not going to give us a FICO, and sometimes we can run it through them paying, but it's only going to give us one company. We have 3 different companies that acquire or are looking for the credit scores that we have, so we need to run the 3 of them, that way we have a perfect picture of what the credit score is.
Okay. So the recommendation, based on what you're telling me, is to have a full credit report run.
Yes.
Not just partial.
It will be the full credit report with the 3 bureaus.
Okay, and the 3 bureaus. And then when each bureau reports on a credit, they give a score, right?
Yes.
And the score basically is you use the middle score of the 3, correct?
Yes, out of the 3, we use the one in the middle. Let's say that someone has 720, 710, 715. So that means that we're going to go to the 715. We're not going to use the highest, but we're not going to use the lowest. We're going to use the one in the middle.
Okay. So credit is the number one thing. Then you talked about debt. One of the things that's important that I know is when people are buying a house is not to get in more debt in the process of buying the home, because that can disqualify the client. So you look at debt such as credit card debt, car payments, if they own other property.
Yes, what we do is we have to look at a debt-to-income ratio. What it is for the house payment, we cannot exceed 35%. Meaning all the income that I get, gross, not the net, the gross, I can only get 35% for the house payment. All included is 45%. That means car payments and credit cards. The debt or the debt-to-income ratio has to be 45%. You can go higher than 45%, but the recommendation is to keep it below 50% because you have to think about it. We're taking the gross, not the net. What I'm saying, the gross is the money before it's taken for taxes. So the net is once we pay taxes, that's the net that we have. So we keep our debt-to-income right in house below 45, we're going to be fine. Because remember that we're paying taxes in the money that we're getting.
Okay. So what I hear you saying is like from each dollar that a person earns, they should not be spending more than 45 cents out of each dollar, correct?
Exactly.
And the maximum would be like spending 50 cents out of each dollar.
Yes.
Correct? Okay.
That would be even pushing it, but that would be perfect.
Okay. So what's the difference between an FHA loan versus a conventional loan?
The main difference with the FHA loan is you require a little down payment, 3.5%, and we do have programs that can help you out with the down payment assistance programs that we have.
Okay.
And you have mortgage insurance. The mortgage insurance is higher in the FHA than in the conventional. Mainly the FHA is used for people that is a first-time home buyer. They don't have the down payment 5%, 10%, 20% down payment. So the FHA is mainly focused on targeting for the first-time home buyers. Someone that has a down payment of 5% to 10%, 20%, and they have a 640, 620 FICO, we can get into a conventional. Now, if they are above 80%, they have to have mortgage insurance. But the mortgage insurance is less expensive than in an FHA loan.
Okay. So FHA loans would be primarily for someone who's buying first time. However, not necessarily only people buying first time, right? I mean, somebody else who's bought a home before and they sold it, now they want to buy another home. Could they get an FHA loan?
Yes, they can get an FHA loan. What it is, a program, like I said, it is targeted for the first-time buyers, but it's not for the first-time buyers. If someone sells a house today, and for some reason they're not cashing out as much as they were expecting, we can put them into an FHA loan. That's
Okay.
not a problem. Now, if you have a house currently you don't have an FHA loan, and you're going to acquire a second house where you're going to move, and you don't have enough money for the down payment, you can get into the FHA loan. The
Okay.
only thing is you cannot use the down payment assistance programs because
Okay.
you're a homeowner already.
Okay, so if I have a home and I want to buy another home, as long as I'm moving into that other property, I could get an FHA loan if I don't have enough income or down payment money for the down payment of 20% or something like that.
Yes,
right?
yes,
Okay.
yes, you can.
And what's the maximum loan amount for FHA loans?
The maximum loan amount is 96.5%, meaning 3.5% is a down payment, so we have a 96.5
Okay,
that we have to do the maximum. But once we combine it with other programs, let's say that we're going to get a down payment assistance program, that loan to value could be all the way up to 105%.
wow. So they can buy something that's, you're going to finance 105% of the purchase price.
Yes, what it is
Wow.
is, let's say that we need 3% for the down payment.
Okay.
So we can give them 3.5% for the down payment. Now we have another program that based on the zip codes, according to the city and the state that you are, you can get additional $6,000. So that's going to push up the LTV to 105.
Okay.
In some of these cases, even with a limited investment of $2,000, $3,000, you can get into a house.
Wow, that's amazing. I think most people probably don't realize that they could get into a house with less than $5,000.
Yes, most of the buyers, since we don't go out there and inform ourselves what kind of programs we have, because I mean there is city programs and there are state programs that we can use combined with FHA. We don't inform ourselves, so we don't know exactly what is out there.
Okay. So when someone meets with you first time, what are the things that you are looking for when they come to your office? What are the things that they should bring to the meeting with you?
The first thing that I look with the client is the income. That's the first step, even before I run the credit report. Because the income is going to let me know exactly where we stand, more or less what they're going to be able to qualify for.
Okay.
Sometimes they go inside the office and they want to qualify for a house, but the income is limited and they'll qualify for a condominium.
Okay.
So once we come to an agreement that they're only going to qualify for this and they're okay with the condominium instead of a house, then I run the credit report.
Okay.
That way I'm not wasting their time, I'm not wasting my time.
Right.
But mainly what we need is a 1 month pay stubs,
Okay. Well, not pay stubs.
2 years 2 years income taxes,
Okay.
and 2 months bank statements.
Okay.
Their social security and their ID. Those are the only 5 things that we need to start the process of qualifying for a house.
Okay. What if they don't have a social security number, but they have a TIN number?
If they have a T number, they cannot qualify for a conventional or FHA loan.
Okay.
But they can purchase a home. There's different companies that specialize in people that have T numbers.
Okay.
But with them, they need 30% down payment.
30% down.
Yes,
Okay.
but there's those programs out there. Not through my company, but I can send them over with those companies.
So you can refer them to somebody who does those loans with 30% down.
Yes,
So somebody with a TIN number, not social security number, they can still buy a home.
yes, they can.
Okay, that's great information. And the last thing is, how do you determine then what is the best loan for the client?
It's going to be based on the information that they provide. Once we look at the bank statements, we're going to see how much money they have in savings.
Okay.
So let's say they have a 5 to 10% savings. For them, the best thing will be to go to a conventional.
Conventional loan.
Because the down payment is going to be a little bit more, but the monthly payment is going to be less every month.
Right.
So we start with the savings. Now let's say that they don't have enough savings, but we only show, let's say $10,000, but they require $15,000.
Okay.
So then for them, I'm going to recommend an FHA with a down payment assistance.
Okay.
That way we don't deplete their savings. We're going to continue to have their savings because we're going to use the down payment assistance for the down payment. So that
Okay.
means that when they get into the house, there's going to be minimum investment for them, but we're going to have a lot of savings for them.
Okay.
So that way they don't use all their money.
Okay. So what I gather from what you're saying is that when they meet with you, You can run their credit report once you've established that they have the income to qualify for a purchase, whether a condominium or a house, correct?
Yes.
And then at the end of that meeting, do you give them an estimated closing statement as to what their costs are going to be for buying the house, the down payment, prepaid expenses, and the closing costs in total?
Yes, once we determine for what they qualify for, let's say that they qualify for a $300,000 loan,
Okay.
then at the time that I know what the maximum qualification is for the house, I'm going to provide them with a good faith estimate.
Okay.
Now, if we're going to use the down payment assistance program, I will let it know. And they will see that in the good faith estimate. They will see the down payment assistance and how much money they're going to bring in at the end of the transaction. Usually when we're using the down payment assistance, they're coming in with $2,000 to $3,000.
Okay. So at the end of the meeting, you will be able to give them a statement, a document that says to them, you qualify for this much, this is the interest rate that we are projecting. It's not guaranteed, you're just projecting it, and all the expenses that they're going to incur in buying the house, which is your down payment money, closing costs, and prepaid expenses, correct?
Yes. Everything we break down to them because they have to know, and the buyers, they have to know and be aware of what the cost is going to be to acquire the house.
Right.
And also at the end of the conversation, what I do, I tell them, please do not run your credit report. Not so much with other lenders, because they do kind of run their credit report with other lenders. Mainly is don't run your credit report to inquire for credit cards, auto loans, or furniture stores.
Okay.
Let me finish the transaction, and then you can run your credit report anywhere you want.
Okay.
But if you want to compare my rate and my cost with other lenders, feel free to run your credit report because your FICO is not going to drop like many of us believe that it is going to drop if we run a credit report. It will not happen.
Okay, so if they have 2 or 3 lenders check their credit, it's not going to make a big dent in their credit score.
It will not drop.
Okay, great. And any last thoughts about what people should know, especially first-time buyers that are getting a home, what they can expect when they work with you?
They're going to expect great service. And like Rudy said, at the end of the meeting that we're going to have, the only thing that you're going to be able to verify my work is with that good faith estimate.
Right.
Because all the disclosures, I'm going to give it to you probably 3 times during the transaction. I'm going to send it to you by email. Then you're going to sign it when you sign the loan, and then you're going to sign it again when you sign the loan tax. So all the disclosures. But the only way that you can see exactly what we spoke in the day that we met was the good faith estimate, because it's going to have every single detail of how the money is going to spend, and the most important is going to have what your rate is going to be.
Okay.
So that's the way that the clients are going to be able to verify what I do.
Okay. So the importance of you getting pre-qualified prior to you starting to look for a home is number 1, you establish the loan amount you can get, the type of property you can purchase, and then your expenses that you're going to incur when you buy the property. So it's really important for anyone thinking of buying a home, whether you're first-time buyer or even second-time buyer or third-time buyer, is to go first and get pre-qualified with the lender. And ideally, I recommend that you get together with Daniel Barrera. His address is 2651 South C Street in Oxnard, 93033. His phone number is 805-218-9896. Again, he's with Metropolitan Home Mortgage. He's been 11 years in the business. We've done business together. He's taking really good care of my clients, and I recommend him anytime you're thinking about buying a house or even refinancing your home. So that's it for today. If you have any questions regarding financing, call Daniel. Again, the number 218-9896. If you're thinking about buying a home and you're ready, qualified, get a second opinion from Daniel also to make sure you're getting the best rate and the best service. And then call me so I can show you the property and find you the home that you want to buy. So thank you again, and we'll talk to you next time.